You can know exactly what you should do with your money and still do nothing for years. Not because you are lazy, because every month, the market gives you a reason to wait. Prices rise. It feels too late. Prices fall. It feels safer to wait longer. There is always a headline, always uncertainty, always a reason to believe the next moment will be better. But the perfect moment is almost never obvious in real time. Meet Alex. Alex watches the market carefully, reads the news, studies the charts, waits for the signal that prices are finally low enough or stable enough to feel right. When prices fall, fear rises. What if they fall further? When prices rise, regret rises. What if the best moment has already passed? Alex is not unintelligent. Alex is caught in a system where every data point can justify waiting a little longer. The result, often, is no action at all. Meet Jordan. Jordan does something different and considerably less interesting. On the same day every month, Jordan invests a fixed amount. No matter what the market is doing, high prices, low prices, unsettling headlines, Jordan invests the same amount on schedule and does not attempt to predict where prices are going next. This is dollar cost averaging, investing a fixed amount at regular intervals, regardless of market conditions. Here is the mechanical effect. When the share price is lower, a fixed dollar amount buys more shares. When the share price is higher, the same dollar amount buys fewer. Here is a simple, illustrative example. Jordan invests $100 every month into the same investment. Month 1. The price is $10 per share. $100 buys 10 shares. Month 2. The price drops to $5. The same $100 now buys 20 shares. Month 3. The price recovers to $10. $100 buys 10 shares again. After 3 months, $300 invested. 40 shares acquired. The average cost per share? $7.50. Not $10. Not $5. $7.50. Because the fixed amount automatically bought more when the price was lower, and less when it was higher. One important point about that example: it includes a recovery. The price went from $10 to $5 and then back to $10. If the price had continued falling and never recovered, Jordan could still be sitting on a loss. Dollar cost averaging does not guarantee a profit. Its advantage is not protection from losses. It is removing the need to guess the perfect moment of entry. What makes this approach useful is not primarily the math. It is the reduction in repeated decisions. Without a plan, every market movement becomes a potential reason to act, or a reason to freeze. Fear, regret, and overconfidence can make market timing difficult, even for experienced investors. The evidence on professional market timing is not encouraging. Jordan's system reduces the number of moments when those emotions can interrupt the plan. Once automated, the recurring decision largely takes care of itself. There is an important distinction worth understanding. Dollar cost averaging is sometimes discussed as a deliberate choice to delay investing a lump sum you already have, spreading it out over time, rather than committing it all at once. In that specific situation, research has generally found that investing the full amount immediately tends to produce better results more often than not. Because markets have historically risen over time, and money held in cash while waiting is not working. Historically is doing real work in that sentence. Past performance does not guarantee future results. But many people are not in that situation. If you are investing from each paycheck, there is no lump sum sitting idle. You are investing what you have, when you have it, on a regular schedule. In that context, you are not choosing dollar cost averaging over lump sum investing. You are simply building a consistent process from available income. For those people, the advantage of dollar cost averaging is not mathematical. It is structural. A consistent process gives compounding more time to work and removes the decision points where hesitation tends to appear. Putting a version of Jordan's approach into practice is straightforward in principle. Decide on a fixed amount you can afford to invest regularly. Choose a schedule, every payday or every month. Set up automatic contributions into a diversified, low-cost index fund that fits your risk tolerance and time horizon. Then let the schedule run. Not because it guarantees an outcome, because it removes the ongoing burden of deciding whether this particular moment is the right one. Alex and Jordan are not different in intelligence. They represent two different relationships with uncertainty. Alex tries to resolve uncertainty before acting. Jordan accepts that uncertainty cannot be resolved and acts anyway, on a schedule. Jordan's money is invested and has time to work through every market mood. Alex is still waiting for clarity that may never arrive. Consistency over prediction. Discipline over emotional interruption. No guarantee of gains, but a process that gives long-term investing a chance to work. That is what dollar-cost averaging offers. If this video helped clarify something, subscribe to Wealth Decoded. Each week, we break down one financial concept that's worth understanding. Next week, ETFs versus mutual funds. What the difference actually means and when it matters.